Welcome to the Q4 Multi-Asset Outlook with 10x Investments. My name is Michelle Knopf. I run the Financial Intermediaries panel, and this outlook is something we started at the beginning of the year, doing it every quarter, looking at what happened in the previous quarter, and then looking at our positioning and key themes and trends to watch in the quarter ahead. This content is designed for professional investors and fund buyers. And for this quarter, we are doing a recorded on-demand webinar because many of you joined us in person at the 10x Think Investing Convention up in Joburg. And so we were really pleased to interact with you in person. And so from next quarter, we'll go back to doing these live. So just please, if you have any questions after today's session, please feel free to email us on intermediaries@10x.coza. But as you know, we've got Anton Eser with us, our CIO, and Chris Eddy, our head of multi-assets, and I'm going to hand over to them. Thanks, guys.
Great. Thanks, Michelle. And yeah, welcome everyone. Yes, please also do send, as Michelle mentioned, please send questions. Normally we take them as we go through, but obviously this quarter is slightly different. But any questions you have, please send them through and we'll be happy to respond. So in terms of the structure of today, pretty much like the last quarter, which most of you would have been on, we're just going to refresh, as Michelle mentioned, the themes we had in the last quarter, talk a bit about what actually happened, which most of you will know, and then spend most of the time going into three kind of really important themes in terms of the portfolio positioning, and then wrap up at the end with a little bit about how the overall portfolio is positioned. So yeah, just very briefly, last quarter. So this was back in July when we had the last call. It was a few weeks after the formation of the Government of National Unity. So we spent quite a lot of time going into our views and positioning there in the portfolio. We went into US equity valuations and spend some time talking about where US equities are, and in particular kind of the impact of higher interest rates will have on valuations. And then finally, we spent a bit of time on the US economic cycle, in particular the discussion around inflation and the disinflationary trends that we have been seeing over the last 12 months. So overall, that's kind of what we went into, and today we'll cover some of these topics, and we've added a couple to them as well. So, Chris, you want to cover off the last quarter?
Yeah, I think one of the big market events in the last quarter was obviously the 50 basis point rate cut that we saw in the US, and that really kind of the narrative from about June started changing as inflation came under control, and you saw some deterioration in the US labor market, and really the sort of the narrative out of the Fed was kind of shifting from focusing on inflation to more considering kind of their second mandate around US unemployment. And off the back of that, we saw rate cut expectations being priced into curves both locally and globally around the world. And that really saw bond yields rally quite significantly. In the US, we saw the US 10-year rally by about 60 basis points over the quarter. And in South Africa, off the back of lower core rates, as well as some of the positivity around the GNU and the political situation, saw the South African 10-year rally just under 140 basis points. So set against those declining yields, we really saw many of the interest rate sensitive assets rally quite significantly over the last quarter. We saw a combination of those falling global rates together with some of the SA reform that we spoke about in the last quarter really provide quite a strong underpin for the rand. So it rallied about 5% over the last quarter. Obviously, in terms of thinking about how that impacts one's portfolio, that would sort of detract from the headline return from offshore assets. And really the big theme that we've continuously been speaking about has been US equities. So although there was quite a lot of volatility during the quarter, we saw the unwind of the Japanese yen sort of carry trade, which led to about a 9% sell-off in the S&P 500 in August. It still rallied back to all-time highs, really on the back of continued valuation expansion. So whilst there was a short-term wobble there, kind of the US equity markets, and as a result, global equity markets back to all-time highs and continuing to power ahead there. So those are kind of some of the big drivers in terms of asset class performance. If we take a snapshot, and here we've really split the assets between growth and defensive assets. What you can pick up certainly on the 3 months, so that's the darker blue line, is really that many of those interest rate sensitive asset classes performed well, both SA property and developed market property outperforming the relevant equity markets. We've seen bonds, both local and global, outperforming cash, and that's to be expected set against that environment of falling yields. But I think the big key takeaway for investors is both over the last 3 months, but equally over the last year, we've had really strong returns across a wide range of asset classes. So remaining invested, I think as investors, we can be quite happy in terms of the absolute level of returns that we've managed to generate over the last 12 months, which obviously leaves us feeling a lot better as we're growing our wealth in real terms well above inflation. What you can notice as well is that generally over the last quarter, South African asset classes, somewhat supported by the rally in the rand, really outperformed global asset classes there, given that kind of 5% rally that we saw in the rand. So that gives you a sense of how the different asset classes performed, and when that rolls into our performance, two things to really, I think, call out here is first the 1 year number, 18.5%. I mean, that's a fantastic return. You had sort of inflation running actually below 4% in South Africa. So I mean, sorry, below 5% in South Africa. So that's really strong real returns on a 1 year basis. We spoke in the last quarter about, given the relative valuations across growth and defensive assets, how our portfolio is slightly more conservatively positioned with a higher allocation to defensive assets. So we have seen over three-month basis slight underperformance, but in an environment where you're able to generate returns in the region of 19%, that is quite key for us. And as you stretch that time horizon out, really consistent long-term outperformance relative to the peer group. Here are capital market assumptions. These are really the returns that one can expect from different asset classes over the next 5 to 10 years. They tell you nothing about how an asset class will perform over the next 3, 6 months, or even the next 1 year. I think the one observation is, given the strong rally in assets that we saw over the last quarter, really across the board, expected returns are slightly lower than where we were sitting in June. And probably the biggest change has really been in South African nominal bonds. You can see at the last quarter, we're expecting to kind of clip about 5.8% over the next 5 to 10 years from South African nominal bonds. And given the really sort of more than 150 basis point rally that we've seen, those real return expectations are now down to about 4.6%, which quite interestingly is actually lower than where South African inflation-linked bonds are sitting. So typically you would expect, as you step up the risk curve, to be compensated accordingly. So that's been one of the big changes over the last quarter. The pink dots on the screen really show you where asset classes have returned over the really long term. And I think the two key observations there is that despite the rally in bonds that we've seen locally, the returns on offer from this asset class are far and away much higher than what we've seen over the longer term, with South African nominal bonds really over the longer term delivering about real plus 1.8% and linkers closer to real 1. And you contrast that the valuation opportunity from South African bonds against really elevated valuations out of the US, where you're expecting returns with some sort of valuation mean reversion, really negative real returns to US equities over the next 5 to 10 years. So as we step back and think about how we're looking to build portfolios to deliver inflation plus 5.5 over the next 5 years, really these different return opportunities filter into how we position the portfolio. But we'll unpack those in further detail later on. As Anton mentioned, we're going to be talking about really 3 key risks and opportunities and how that factors into our portfolio construction.
Yeah, and I think one of the things which we have done today is just going back to that previous slide that Chris went over, is these are kind of the average return assumptions. What we've done particularly for US equities and SA equities is just gone a little bit more detail into the various scenarios that we see, just so you can get a better feel for the way we think about long-term return expectations. We obviously do have a kind of an average return expectation, which is what you're seeing here, based on a very formulaic methodology. But then we also run scenarios around, what is the distribution of potential returns. So we'll talk about that particular for US equities and SA equities today. So yeah, as Chris has mentioned, we're covering three critical themes for an SA investor. US equities and SA equities are a huge portion of the portfolio, so really important for us to kind of delve into what we think there in terms of return expectations. I mean, this is a slide which shows really what's happened in the last 25 years in terms of the global exposure in SA retirement funds, which was back at zero in the late 90s. And as we all know on this call, it has kind of gradually increased over the last 2 decades to the increase recently of 45%. And then alongside that is what you see here is what's happened to US equities within that global allocation. So back in 2008, that's kind of around the time of the financial crisis, US equities, around 43% in terms of their weighting in the index. So still, relatively high, but really what's happened over that 15-year period is 43% has become 65% over that over those 2.5 over those 15 years. So if you really put those two things together, the weighting has gone from back in 15 years ago to where we are. The weighting of an average South African retirement fund to US equities has gone from about 5 or 6% to anything around 30%. So it's become it's obviously a critical asset class for all of our funds, and the kind of exposure to US equities for South African retirement funds is a big part of the portfolio. I think that the other thing which is noticeable is really what's happened in terms of performance of global equities versus SA equities. And what we put up here are two charts. So we took the period from 98 to 2010, where we had obviously a very strong local market, and compared that to what's happened to MSCI World, so that's developed market equity in rands. And you can see on an annual basis for 12 years, SA outperformed DM by a staggering 16.7% per annum. So incredible relative return of SA versus developed market. And it's actually important to remind ourselves of that, because the opposite's happened over the last 15 years or 14 years, is that developed market equity has been very strong, in particular obviously US equities within that, but developed market has outperformed the local market by 8.3% per annum for 14 years. And the reason to highlight that is just to give us all some context from a long term, in terms of decades over decades, what happens in terms of long-term returns in asset classes. And obviously in this industry, we get very obsessed about the news flow and very focused on what's happening over the short term. But often we do lose kind of the context of the importance of major structural themes and major structural changes that happen in markets, often driven by valuations. And we have spent a lot of time on this in these calls. We covered it a lot last week at our Think Investing conference. And it's been really a theme which we've been really quite vocal about over the last year, really the whole of 2024. And for those who've been on these calls, they will know it relatively well. So we won't go into a huge amount of detail. The last call we highlighted the impact that lower interest rates and lower taxes have had on earnings, and also highlighted the increase in valuations. really, in summary, kind of that almost 40% of returns over the last 3 decades in US equities have actually not been driven by earnings. They've been driven by, so organic earnings have been driven by interest rates, taxes, and what you see here on this screen, which has been a massive multiple expansion over the last 3 to 4 decades. This chart here is the cyclical adjusted PE ratio, which we find very useful because it kind of smooths out volatility in earnings. It also doesn't use forward earnings because forward earnings is obviously a forecast, and we know how bad the market is at forecasting anything. So we really want to use the numbers that we know. So the CAPE is the last 10 years kind of smoothed out inflation adjusted earnings. And you can see, over this period of time that the multiple has got to 35, 35 times in recent days. And really the only time that's happened over the last 130 years, I mean, not even including the 1929 bubble, is the only time that's happened is really in the late 90s, early 2000s, with the TMT bubble that we now know of, where the CAPE got to just under 45. So, it's as Chris mentioned, it's not particularly useful telling us anything about what could happen in the next 6 months, 12 months. You can see there with the CAPE in the late 90s. I remember kind of began my investment career back then, and what looked like a high CAPE obviously got higher and higher and higher. So it's absolutely not a forecasting tool for the short term, but it's super useful in terms of understanding what that means for the long term. And we will go and sort of stick on this for a section. We'll go into that when we talk about the different scenarios. I think one of the things which we often get some questions on is around earnings growth and around just for example what's happened in tech and just how fantastic the earnings growth story is in the US. And I think if you speak to any bottom-up equity analysts, they'll tell you a very positive story. And we do believe in positive stories. When we go into the SA market, we'll talk a lot about that. But if you take a step back and you look at the last 2 years, Chris and I were going over these numbers recently, and you look at the what's actually happened in the US. So you take earnings growth over the last 2 years, and we'll take some kind of forecast into the end of the year, so kind of full year 2024. And the nominal earnings growth from the end of so the last 2 years, nominal earnings growth has been 6.7% nominal, right? So let's just factor in 6.7% nominal growth in the last 2 years in what's been a booming economy. You adjust that for inflation, you basically get to zero real earnings growth in the US over the last 24 months. Now, alongside that, you've had a 52% rally in US equities. So once again, let's just do the same thing. Let's adjust that for inflation. So, a real return in US equities of 44% when you've had a real return in earnings of zero. So that really means that your multiple expansion has accounted for all of the US equity return over the last 2 years. In fact, the multiple, the PE to last 12-month earnings has gone from 18 to 27, so a 50% increase in the PE multiple. So I think just we although the CAPE is very much looking at long term, it's just useful to have the context of really what is going on here. This is a pure multiple expansion in the US over the last 2 years. So whether you're using price to current earnings or whether you're using a CAPE like this, which we find is very useful for the long term, it is really a period of time in US equity markets which is apart from the late 90s, early 2000s, is unparalleled. So it is important to kind of have that frame of reference.
Bull market and expectations rather than actual earnings.
Yeah. And but once again, we are seeing strong markets at the moment. And Fed's cutting interest rates, ECB's cutting interest rates, China's cutting rates, which we'll talk a bit about today. So in that environment, it's super possible that we have another 10-15% and we get to a CAPE of 45 within the next 6 months. So it doesn't tell us anything. We keep on saying that about the next 6 months. So this is a table which we use for all of the asset classes that we manage the portfolio. And I mentioned earlier on that we have kind of the long-term capital market assumptions, which are for each of the asset classes. You can see how they stack up alongside that. But we also do run scenarios just to get an understanding as to what the potential upside and downside is around that central base scenario. So in this chart, you can see the top, so the kind of the dark blue where we say real EPS growth. We've got 5 scenarios here: 1.6, 1.82, and 2.3 and 3.5. The last call we talked about the impact of interest rates and taxes. So we've taken historic EPS growth and we've adjusted that for the impact of higher interest rates, not for taxes, but higher interest rates. And that kind of gives us to that second scenario, that 1.8% EPS growth. And then down the left-hand side, we've just plotted what does the CAPE eventually end up at over the next 10 years. So the top one there is a current level of 35. The 26 is the last 35 years average, and the 20 is the longer-term average for the CAPE. So you can see there's different exit CAPE scenarios. And then really in the table is just what does the combination of that real EPS growth and that exit CAPE lead to in terms of the return assumptions in US equities. And then you can see we've kind of applied the dark blue, which is our central base, and then there's a lighter blue. And even in the scenario whereby the CAPE remains relatively elevated and we somehow get 2% EPS growth, it's still a real return expectation. US equities are below 2, compared to a real return that we've had of 8% over the last 35 years. So the central case scenario is what we call a lost decade for US equities, where we have negative real returns. But importantly, it's not only the central case scenario, it's the kind of the upside of possibilities in terms of, even if the CAPE remains at an incredibly high level and real EPS grows at a level which we haven't seen in the US, you're still talking about a relatively low real return. The final point to make is that the tailwinds for US equities around lower interest rates, lower taxes, and higher multiples are unfortunately behind us and are now kind of headwinds. So, a hugely important part of any South African retirement portfolio, 25 to 30%. So, clearly this is an important kind of expectation in terms of where we see things from here. The other point to make is just to finish up on this one is so we've covered S&P 500, is that everyone talks, we talked a lot about in the last call around the role of tech and how large that has become in the US equity market. We just compared this to a couple of other US related indices, and you can see the equal weighted over that same period of time. So this is just every S&P 500 company is 1/500th of the index. And you can see within that, it's a far different story where you've seen the CAPE ratio go from 21 to 23. And then a kind of a topic which we've talked a lot about is the dividend strategy, which is much more high quality, non-cyclical type of companies that we know very much have grown incredibly well in terms of their earnings growth. In fact, higher earnings growth than the broader market. The multiple is really hardly moved over that 10-year period. So it really is a multiple expansion in a small part of the market, but the overall impact it has on overall levels of multiples is clearly very high. And we'll talk about what that means for the portfolio when we go into that. So Chris, I'll hand over to you to finish up on this one.
Sure. So I mean, just to kind of like land those points very succinctly that Anton was making. I mean, we've got really stretched valuations in the US. The CAPE ratio is at its 95th percentile going back over the last 50 years. And really, as Anton mentioned, anything but really a perfect scenario is really set to deliver a lost decade. So really, as one thinks about delivering real returns that tie back to the investor outcomes, it's really a critical role that market cap US equities will play going forward. And how do you think about managing those risks? Because not all parts of the US equity market are that expensive, and obviously markets outside the US equally don't have as demanding valuations as the S&P 500. So that certainly plays into how we think about managing those risks. Obviously, over the last month or so, there's been a lot of news out of China. We saw a 25% rally in September off the back of many stimulus measures that were announced. I think context here is quite important because there's a lot of euphoria around Chinese equities in 2020, 2021. And really, we've seen a combination of measures ultimately from sort of a centrally planned economy. First, in terms of trying to deflate the property bubble that's been growing for many years in the US. The Chinese government implemented a 3 red lines policy, which is intentionally trying to deflate that property bubble in a managed way. Given that the property sector was really the main and broader investment was the main growth driver in the Chinese economy. What that's meant is that Chinese growth is starting to come under pressure. We're seeing quite strong deflation coming through from the Chinese economy. And that also happened at a time when really sort of under the guise of common prosperity, there was a clampdown on lots of different sectors in the Chinese stock market, primarily in tech and tech-related. You can remember some of the crackdowns on those education tech companies where basically overnight or 2 days, the entire equity value of those companies were wiped out. And at that point in time, many investors were saying, you know what, there's significant growth headwinds. China's becoming uninvestable. And as a result, investors voted with their feet, and we saw significant rotation out of Chinese equities. The fact that that market derated significantly. And despite the 25% rally that we've seen in September, Chinese equities are still more than 40% down since the highs in 2001. So there's been a raft of measures that were really announced consistently, sort of every couple of days over a period of 2 to 3 weeks, from monetary stimulus to fiscal stimulus, support for buybacks, stock market liquidity support, and fiscal measures ultimately to shore up local governments so that they can really shore up the broader property market. So off the back of this, I think where you have a market that is so significantly underowned, it's also at really attractive valuations. Kind of the range of scenarios is certainly tilted to the upside, and that's really what's underpinned the rally that we've seen. So if we take a step back, because I think it's important here to really look at sort of the broader valuations, because that's a measure in terms of what type of information has been discounted by market participants. You can see that from the highs, the CAPE ratio in MSCI China as a proxy for the market at the end of beginning of September 21, when the market topped out, was really at about 23 times earnings. And that derated all the way to about 12 times earnings before this sharp rally that we've seen over the last month. But where we're sitting now at 15 times earnings, you're still far below that longer term average of about 20 times. So there's been a sharp rally and some excitement around some of the measures that have been really implemented. But I think the key takeaway here is when valuations are cheap, the range of returns and the different scenarios are certainly skewed to the upside. It's not to say that Chinese economic worries and problems are behind us, but it's really about what's been discounted in market valuations. I mean, there's maybe two more points to make, because at that stage, everyone thinks about allocating to emerging markets as sort of a homogenous market. Right, China made up a significant proportion of that market, and following kind of the 2021 scenario where really markets, many investors thought of China as uninvestable, you've seen a significant shift into emerging markets ex-China. I mean, since 2021, so the numbers on the chart here talk to $20 billion have been sold from broad emerging markets, and equally $20 billion have been invested in EMX China. So you can think about that as ultimately allocators who allocate to emerging markets as an homogenous asset class have been intentionally looking to exclude the Chinese market.
So on this, so there's 20 billion of total outflows from EM funds, Okay, and then ex-China is 20 billion out, right?
20 billion in.
20 billion into EMX China,
Yeah,
right? So
yeah.
the net flow is 20 billion from Chinese equities, or it's a double element, right? Because if there's 20 billion into EMX China and there's 20 billion outflows from EM funds, then there's a $40 billion foreign outflow from Chinese equities over this period of time.
Yeah, net weighted
Yes.
for its exposure as well.
Yeah, I mean, I think once again, if you kind of look back at the last 10 years, and kind of you look at this last decade in Chinese equities, and we try and remind ourselves what the world was like in 2014. In 2014, the BRICS story really was the only story in town. We'd come out of the global financial crisis, we'd come out of the European debt crisis, and China had just embarked on a massive fiscal expansion, the one 2008, 2009, and then a few years later. And back then, everyone really was falling over themselves to invest both in the equity market, set up foreign companies inside China, build asset management capability, build financial services capability. It really was the growth story. And to kind of roll the clock forward 10 years and look at how that narrative has changed, it's quite something. And I think the point that Chris highlighted there around what happened in the last few years around the China story, around this kind of conclusion at the beginning of this year that it's uninvestable, is really interesting when you kind of apply a historic lens and a global type of perception around risk appetite and how central banks behave. Because in the end, if you look at what China did around the property bubble, where we had some very high profile defaults, some significant investment grade property companies, Evergreen and Country Garden, and that type of default doesn't happen in developed markets. We obviously saw Lehman in 2008, but you've seen very little I'd say appetite for something like this, to actually allow a massive part of the economy to deflate in the way that they've had. The perception from the developed market investor is a conclusion that, well, no, it's uninvestable. It's ultimately kind of hugely problematic. But actually, in a sense, it was allowing the market to effectively get rid of highly levered property developers.
Creative destruction, which is really
that's right,
like key to kind of a more traditional economic cycle.
Yes, and it's just quite something. Over 10 years, it is the only story in town. Now it's uninvestable, and there've been a lot of things that have happened. Obviously, we haven't talked about kind of trade tariffs, haven't talked about the geopolitics of it all. But actually, what has happened in China was a recognition of a bubble, an attempt to deflate the bubble, and the impact that has on the economy has been massive. So it's and as you can see, the flows have happened, and that flow, I'm sure you're going to pick up on the next slide, that flow into Indian equities, it's kind of been the obvious benefit.
Yeah. So here we've just basically plotted kind of how many people think about this homogeneous asset class, how it's evolved over time. So we've really picked out India and Taiwan, which have really been the EM darlings over the last 2-3 years, and we've grouped them together. And we've plotted that against the weight of China, and then we've kind of just bucketed all the other exposures. And you can see that collectively, India, Taiwan, and China have been significantly increasing in size. So much so that kind of they make up more than 60% of emerging markets, these three countries now, and kind of the tail and the residuals getting smaller and smaller. But you had China at over 40% and at kind of the top of that sort of Chinese equity bubble in 2020, 2021. I think it intra-year topped out at about 44%. And really people thought about, well, there's one risk factor when allocating to emerging markets, and that's purely China. But really what's been happening off the back of the flow of funds, and admittedly really great economic reform in India, which has underpinned strong earnings. And obviously Taiwan has a very idiosyncratic risk around TSMC as really the chip manufacturer that's underpinning a lot of the sort of the AI frenzy and feeding into Nvidia and the likes. But really, you've kind of had this evolution where now India and Taiwan make up kind of just less than 40% of the market, and China's down to about 27%. I think in June it was down to about 25%, because it's 27% now after the rally we saw in September. So really, kind of when you think about allocating to emerging markets, the emerging markets of today is not the emerging markets of 3-4 years ago. And what's even more illuminating is when you kind of look under the hood from a valuation perspective, you can see that whilst headline emerging market valuations are maybe slightly elevated compared to the longer term, that's really bifurcated between this cheap China, which obviously has many headwinds that we've kind of spoken about today, but ultimately that's reflected in valuations set against these really elevated valuations. And I mean, we've spoken about how expensive the US market is. The Indian equity market is probably the one market globally that's more expensive than the US, sitting at 41 times cap ratio, and Taiwan at 30. So when you look under the hood, whilst headline valuations in the EM are attractive, it's really driven by two really bifurcated kind of giants under the hood. So as we think about more broadly allocating to emerging markets, and given that our process looks out over the next 5 to 10 years and is underpinned by valuations, we have been thinking about how we're managing the risks at a headline emerging markets level, and have been systematically allocating more to China and downweighting kind of the India and Chinese exposure that comes with broad emerging markets. So yeah, I mean, maybe just to kind of wrap up, I mean, do you want to any concluding remarks on this topic?
No, I think that's pretty clear, Chris. I think let's move on to the SA equity. Actually, let's wrap up in terms of the global exposure. So this slide kind of pulls together, effectively what we talked about in terms of the US concerns, and also brings in this point around our China exposure. So I'll just kind of tell you what's in front of you. So on the top left here, this is the geographic exposure. So you can see the US weighting in ACWI at 67%. Right through to China and Hong Kong and EM ex China. That's the dark blue, and then the lighter one is the 10x regional exposure. So you can see that, as you would expect, by virtue of what we've been talking about in the US, our weighting in the US is significantly below ACWI. And then on the right hand side, there's a kind of breakdown in terms of the sector exposure, and obviously, as you would expect, with the US underweight. The tech exposure is very low. And just to point out one thing is that we're not allocators from a sectorial basis in terms of intentional views, and we also ultimately looking for really one thing, which is the most important thing, which is diversification. And when you have such a concentrated market, the US 67% of global, and within that 40% or so is in a handful of companies. That is not a very diversified global exposure. So our first intention is really around diversification. We want to ensure that our, for example, the top 10 holdings is diversified, whereas the ACWI 22% of ACWI is in the top 10 holdings, whereas the 10x portfolio we have 7%, and this kind of then filters through into this CAPE ratio, where through that diversification, through an allocation to our dividend strategy, for example, the CAPE ratio is much more kind of sensible in terms of where it is relative to the long-term average that we spoke about earlier, whereas ACWI is very high. The other point to pull out here is just to Chris's way he's described how we've been looking at China. So obviously as valuations have got cheaper, so our kind of systematic approach has enabled us to buy and allocate more to China, both Hong Kong and domestic. And you can see that there in terms of our China and Hong Kong exposure at 14% relative to now what's a very low exposure with an ACWI of 3%. So the portfolio, kind of this allocation of DM versus EM, it is an overweight EM exposure and an underweight US. That's already the kind of the main call outs in terms of how we've kind of constructed the global equity portfolio. We'll talk about how that kind of fits together with the total global equity exposure towards the end.
Yeah. And then then for some of the positive news, and I think some of the more sort of rosier outlooks, we've really seen a rally in South African assets in Q3. That's coming off two things. One, obviously, sort of really depressed valuations leading up to the elections in May, coupled with obviously a positive outlook. In the last webinar, we spent quite a lot of time going through some of the unappreciated economic momentum, obviously around load shedding, etc. And where you kind of have a sort of an upside surprise and some of the sort of the unappreciated positive news together with low valuations and kind of very, very low positioning, that's really led through to a rally in South African assets. It's quite interesting in terms of the observation is it's really been the interest rate sensitive parts of the market that are rallied, which talks to not only the positive South African outlook, but set against kind of the global context of what's been happening with core rates rallying around the world. So South African listed property has been the star performer, up just under 20% over the quarter. South African nominal bonds up about 11%. The all share up about 9%, and inflation-linked bonds up about 5% against cash of about really sort of 2%. So it's really been a strong quarter for South African assets. If you look at bonds more specifically, what you had happen really post the election is at the time of the election, you had sort of break-even inflation priced into the South African bond market of about 7.5%. And that was really discounting kind of two really separate scenarios. One of a positive election outcome, which is what we experienced, which one can expect to sort of call break-even inflation of 5%, and a negative scenario where you would have much higher inflation risk and break-even inflation of about 10%. So kind of going into the election, a lot of uncertainty, market was sitting at about 7.5%, about 50% of either of those scenarios. As we obviously moved into the positive scenario, we've really kind of taken a lot of that inflation risk off the table. And that's what you've really seen in terms of the chart on the right-hand side. So South African 10-year break-even inflation has rallied from over 7% to kind of around 5% and just below 5%. Now, what's quite interesting is that that's underpinned the nominal bond performance. But set against that, the other component of high elevated yields in South Africa is the real rate component. And you really haven't seen a significant rally there. You still have real rates on the South African 10-year just below 5%. And when we think about the outcomes we're looking to deliver in this portfolio, which is kind of inflation plus 5.5%, that is really the lowest risk way to deliver that outcome across the portfolio. And the reason why you still have these elevated real rates is that set against an environment of declining inflation. I mean, there's some estimates that inflation will come in with sort of a 3.5% handle in Q4 of this year. We know that the Reserve Bank governor has been typically quite conservative in terms of how he implements monetary policy and how the committee implements monetary policy, and they've really kept relatively tight monetary policy, which has created these higher real rates in South Africa. But ultimately, as investors, it creates a great investment opportunity as we look out over the next 5 to 10 years. So a rally in nominal bonds and linkers really haven't moved. So now as we think about how we allocate going forward, really there's very little inflation risk discounted in nominal bonds, whereas inflation linkers give a lot more asymmetry to both positive and negative scenarios going forward, whilst guaranteeing a really high rate of returns. So we've seen a strong rally in South African equities, about kind of just under 10% over the quarter. I think a question many investors are asking is like how much of the good news has been really discounted in what we've seen. But if you look back over the longer term, again, we're using the cap ratio here to kind of contextualize where we're currently sitting relative to the longer term. We can still see that at 14 times earnings, we're slightly higher than where we were at about kind of 11 times cap ratio. So there's certainly has been some of the good news has started to filter through, but we're still far off that longer term average, which is closer to 16 times, and far away from really the buoyant market environment at the start of Ramaphosa's first term, kind of that Ramaphoria period at the beginning of 2018, where you had cap ratio for SA equities at 19 times. So from a valuation perspective, the market's kind of taken a little bit more of a wait and see approach, more of a show me, don't tell me. And actually that sentiment's really been echoed by many foreign investors as well. In the last webinar, we spoke about how over the last decade, there's really been R1 trillion worth of outflows from the SA equity market and R1 trillion worth of outflows from the bond market. Now, we've seen foreigners, we've kind of circled it in the pink circle on the right. They've started dipping their toes back into the local bond market. And we've seen what that's done in terms of pricing, kind of the 150 to 200 basis point rally that we've seen in nominal bonds, and how that's been one of the best performing asset classes locally, given that foreigners have stepped back in and positioning's been very light there. On the equity side, though, foreigners, despite the improved sentiment, have still been net sellers every month over the quarter. Under the hood, they have been rotating kind of a little bit more to sort of SA Inc. and selling the miners, but net, they've still been outflows. So kind of continuation of good news if we see economic growth continue to improve thanks to some of the changes to structural reforms, but there are also some kind of cyclical, more shorter-term underpins. We've seen recently, I think it was yesterday, SARS came out with the fact that there's been about 21 billion worth of claims from the two-part retirement, which would certainly give a shot in the arm to consumers. And the other interesting thing when we think about rate cuts is that from a South African perspective, there is only 1% of home loans that have a fixed rate. 99% are floating rate. You contrast that to many other markets. I think the US has about 90%, close to 95% fixed. Even many European markets, even though they're only fixing for 5 years, are kind of sitting at that 50%, 60% fixed. We've got the highest sensitivity in terms of kind of increased sort of residual spending from rate cuts that will benefit the local consumer as we move into this rate cutting cycle. So really that sensitivity to rate cuts in terms of increased consumption that can flow through to high economic growth is much greater in the South African economy than it is in many other economies. So those two factors around rate cuts and kind of two-pot could give a shot in the arm in terms of kind of shorter-term economic growth. But the reality is, I think the scenarios that we're looking at here in terms of the next 5 to 10 years are not necessarily predicated on what happens over the next 3 to 6 months. They're not necessarily predicated on kind of short-term economic growth uplifts. Really, the attractive valuations, high dividend yields create a range of scenarios that can deliver real returns above 4%. Our base case here has real EPS growth at 2.6%. Interestingly, despite all the headwinds we've seen over the last decade, that is the real EPS that the JSE produced over the last 10 years. So not really a demanding scenario in terms of earnings growth, and kind of sitting with an unchanged valuation metric at 14 times earnings, one is able to kind of generate more than 6% real. There are very few scenarios that kind of CAPE ratio of about 10 times, which is aligned with the bottom of the GFC, it's aligned with the bottom of kind of COVID markets, that really delivers relatively soft returns that are kind of in line with the broader base case for the US market. And then if you start looking to the upside here, kind of re-rate, let's say, to a Ramaphoria type valuation metric at 19 times earnings, and say that we're able to generate slightly higher EPS growth because South African corporates have really become very resilient in terms of shedding a lot of their cost base, as well as the fact that things like load shedding have been really a big headwind to revenue. You kind of remove some of those headwinds out, and let's say you generate 3.3% real EPS growth, which interestingly, over the last 20 years, is only at about 40th percentile. And you're looking at real returns above 10%. So really kind of the range of outcomes, it certainly looks a lot brighter for SA equities.
Yeah, I think it's super interesting to see that the worst case pretty much scenario of this table at 0.5% real return is the base case, actually above the base case for US equities. So I'll leave it on that. Right, yeah, let's wrap up, Chris, with just a few comments on the changes that we've made over the last quarter, and then most importantly, let's spend a little time on the portfolio positioning slide as to where we are. I think just a few points just to bring out here, which we've just simplistically described here in terms of what we've been doing. So we've kind of mentioned it in terms of our thoughts on US equity and China. So as you can see there, we've been actually reducing the MSCI World, so the developed market exposure, and with that, we've been allocating more to our Global Dividend Aristocrats ETF, which, as mentioned earlier, is a kind of consumer non-cyclical quality portfolio, consistent dividend paying, very defensive companies. So that's the one thing we've been doing. Secondly, just a kind of reallocation within our EM to increase the China equity exposure within the portfolio as the relative valuations got more and more attractive. So we've been increasing more in China. And then the third point really is the switch, which we've started earlier this year, and have just been continuing to add to it, is a switch from nominal bonds into inflation-linked bonds. Our model has a real return expectation in nominal bonds, which is lower than inflation-linked bonds, which doesn't really make any sense when you have inflation risk in nominals and you don't have inflation risk in inflation-linked bonds. So three kind of main themes.
Yeah. So, and from our overarching portfolio positioning perspective, when we went through those capital market assumptions, I think the big call out there is that defensive assets are fair to attractively valued, setting returns either in line or above their long-term average. And growth assets are either fair to expensive, and are set to deliver returns effectively in line with or below their longer-term average. So as a result, kind of our positioning is more defensive. We have a higher allocation to those defensive assets. We've got about relative to our longer-term benchmark, we're at about a 5% overweight to defensive assets. And really that's driven through that big overweight to South African inflation-linked bonds. That's really the key overweight. And then there's an underweight to developed market equities, primarily that US equity exposure, which then also feeds through to higher local exposure with a larger allocation to SA equities, given the range of real returns that asset class is set to deliver. So kind of really, in summary, higher allocation to defensive assets, higher allocation to onshore assets, and more rands in the portfolio than we would through the longer term cycle. Ultimately, we remain defensively positioned. So if we have an environment where markets continue to run, US equities continue to push out to 40 times cap ratios, Anton mentioned, the absolute returns that will generate for our investors will be really attractive. But it's in that scenario where you might have markets starting to come under pressure because of those elevated valuations, where we set to deliver much better returns in those kind of negative environments than we would more typically through the cycle at our benchmark weights. And that's how we really think about the end objective we're trying to deliver for investors of inflation plus 5.5% through the cycle.
No, that's great, Chris. I think it's a nice way to wrap up. So thank you everyone for your time. Sorry we weren't able to do this live and get this more interactive, which we far prefer. Not listening just to our own voices, but hearing other comments and questions and making this more interactive. But we'll be back to kind of the normal live webinar from next quarter. And yeah, wishing you all the best as we go into the end of the year. And good luck on the investing front. And thank you very much for your time. Thank you.
Yeah, if you have any questions, please do feel free to pop them across. We'd love to engage with you on that. But thanks very much for listening.